Good afternoon, everyone, and welcome to our Friday webinar. This is Terry Horan, President of Horan. With me is David Templeton, Managing Principal of Horan Capital Advisors, Michael Napier from Horan Wealth, Paul Carl from Horan Wealth, and on the phone is Michael Hermes, CFA, also with Horan Wealth. 10 weeks ago, we started this weekly webinar due to the volatility in the market, and a lot has happened in the course of those 10 weeks. We think this would be our last weekly webinar. However, as the climate changes, we stand ready to respond and will work with you during this uncertain time. As legislation occurs, as legislative changes occur or dramatic changes in the market, we'll find a way to keep you updated. It does appear that there is new legislation in the House and Senate right at the moment, and if this gets passed, we will be back on the line for you. So whether it's in a webinar, email, or personal phone call, we stand ready to go the extra mile, and that is our Horan fundamental for the week. We'll do what it takes to accomplish a job and plus a little more. Whether it's starting early and staying late or doing something not in our job description, it's the extra mile that separates the ordinary from the extraordinary. Today, as we told you last week, our topic is going to be equity market, winners and losers. It should prove to be very interesting. We also have 4 questions from our public that we will attempt to answer towards the end of our presentation. Michael Napier, will you get us started?
Sure. Good afternoon, everyone. Just a quick review of what's happened in the market this week. We've had a fabulous week in the market on the most part. It's been a volatile week in the market. Market's gone up and down quite a bit, but we have returned right about 3% for the first four days of this week. If you remember on Monday, if you follow the Dow was up nearly 1,100 points on Monday. Then the market fell about 1% Tuesday, up 2% roughly on Wednesday, and down a little bit yesterday. And so far, a little flat on the market today. We'll see what happens. But looking at this particular slide here, beginning of March, I think we remember the market fell roughly 31%. In a time span of roughly 2 weeks, and we have rallied back since then. Market's down about 8.75% for the year, and down about 13% from the all-time high. So it's rallied back quite a bit. David Templeton in a second is going to talk about some of the winners and FANG stocks and dividend stocks, but one positive note here is money market assets right now are close to $5 trillion. So money on the sidelines, cash, money market assets, roughly $5 trillion right now. At the peak of the financial crisis in 08 and 09, those assets were around $4 trillion. So we're up about $1 trillion. That can be seen as a positive note. As the market goes down, there'll be some buyers in there, hopefully to stabilize it a bit. David?
Thanks, Michael. On the next slide here, wanted to look at these FANGs, or we call them Magma Stocks, which includes Microsoft. As the chart on this slide shows, the Magma Stocks have had strong performance this year. The average return of the 6 stocks, Facebook, Apple, Netflix, Google, or Alphabet now, Microsoft and Amazon, are up 18.4% as compared to the S&P 500 index, which is the maroon line, which is down 8%. The other 2 lines on this chart represent the S&P 500 Equal Weight Index, the green line, and the S&P 500 Dividend Aristocrats, which is the orange line. As some investors know, the aristocrats are the S&P 500 stocks of companies that have a record of increasing their dividends over a 25-plus year, consecutive 25-plus years. These tend to be your higher quality companies. Both the Equal Weight S&P 500 Index and the Dividend Aristocrats are down mid-teens year to date. So what is the takeaway from all of this? This gets to the theme of our presentation, which is the winners and losers in this current environment. Because the Equal Weight Index has underperformed, that means the smaller sized companies in the index have underperformed the larger cap companies. And we have seen similar situation with the mid cap and small cap stocks as well. If we look at this slide that you see now, one overarching factor at play is the fact that cloud stocks like Microsoft and Amazon are big beneficiaries in this, what we call work from home environment. Microsoft and Amazon are big in cloud storage and web hosting. Microsoft has Microsoft Teams, which is an online meeting software program, which is similar to Zoom, which some of you may have heard of here recently. With Netflix, people are watching movies at home, Apple and Apple TV, Apple Music, and more. Another area seeing growth is telemedicine, which requires storage and internet data capacity. In short, technology has been a big winner in this environment, and we think it's likely to be the case going forward. If we go to this next slide, finally, you see here in an earlier webinar, we talked about the different recovery shapes the economy may experience coming out of this recession. You heard V-shaped, L, W, and U-shaped. Below the letters on this slide, in each box, are some of the industries that might perform best under each respective scenario. We think certain business segments may see different recovery shapes. In our expectation, assuming we do not experience another virus lockdown, is that recovery will be more V and W shaped. However, we think segments like airlines are more U-shaped, same with the hotel and lodging industries. So common characteristics of companies that would do well under these various recovery shapes. In the V-shaped scenario, these tend to be companies that have higher beta and higher earnings yield. And earnings yield is just the inverse of the PE ratio, so it's earnings divided by price. You know, some companies here would be like banks, Citizens Financial, Raytheon, we own for clients. Defensive sectors tend to lag in this recovery environment. In the W-shaped recovery scenario, some of the factors that tend to be representative of these companies, they have high sales or high top-line revenue growth, and they have high alpha. And what we mean by high alpha, it means a company has some unique characteristic in their industry versus their competitors. You know, for example, Google, Microsoft, Crown Castle International. Again, we own these stocks for clients. Crown Castle International is a REIT that owns cell towers, and with 5G rollout, it's been a big beneficiary in this environment. The U-shaped companies, these are companies that have low price volatility and high profitability. And you know, be like a Procter & Gamble, for example. In other words, these prices do not swing hard up or down. Auto parts companies tend to fall in this category. I mean, if the recession is going to drag on for a longer period of time, people will get their cars fixed instead of buying a new one. We own advanced auto parts in this space for our clients. The L-shaped recovery, again, low volatility type stocks. And again, some stocks fall into both categories. Again, a Procter & Gamble, Merck, or your healthcare stocks, utility stocks. These are companies that have strong cash flow and have the ability they have high debt coverage. So either they don't have a lot of debt or they have enough cash flow to service the debt. Again, we believe this recession is going to be mostly a V and a W-shaped type of recovery as we continue to come out of this virus lockdown.
David, I have a question with regards to this. I love all these different letters that we've got here, V and U and W and L, but what would you anticipate performance is going to look like given these various scenarios?
Terry, that's a great question. So interestingly, for the past 1 month, the stocks falling in the V category are outperforming, and as Michael Napier showed it, the stock market's kind of had a V-shaped recovery. However, just here recently, the market's traded somewhat sideways, and on a month-to-date basis, it's the stocks in the W category that have been outperforming. This gets to the fact we do think certain segments will experience different recovery shapes, and we want to be positioned in those ones that will do well. Now, with the V-shaped stocks, we think it's more of a higher risk-reward type of scenario. And by that, we mean if the economy experiences a slow recovery out of the recession, we think these V-shaped stocks could broadly underperform some of the other segments, but that's not what we're anticipating at the moment.
That's helpful, David. I was surprised to see you put airlines in the V-shaped box. Tell me about that.
Yeah, so, you know, assuming the economy comes back strongly, there is the potential that we'll see people, and we maybe touched on this a little bit in one of the other webinars, we think people will be more have to go travel.
Yeah.
The cruise industry has seen some sign of that.
Yes.
We do think the airlines might be able to attract some higher activity if we get a better economic environment. You know, even throw a vaccine in there, that maybe people would feel more comfortable about traveling.
How important do you think it was for this week's performance that people are getting a touch optimistic about a vaccine sooner rather than later? Now, what we have no idea whether that's going to happen or not, but it's certainly been in the news more than ever that people have some optimism that this virus is a little clunky. We should be able to find a vaccine for it quicker rather than later.
Yeah, so it's definitely a plus. If we could get a vaccine, and some of the results out of some of these vaccine studies have been, some of these trials have been highly promising, really. So that is a huge benefit. And I think the other thing, and it's a little bit on the disappointing side from my perspective, as we look at the data, it seems to be the people negatively impacted the most in terms of deaths have been the older, compromised individuals that have comorbidities associated with them. I think they're saying over 50% of the deaths have been from nursing home and long-term care facility patients, which is disappointing that we didn't take better care of the elderly population in all this. But, you know, the vaccine, and then some people realizing maybe the younger population set's not going to be as negatively impacted has helped a little bit too.
I agree with you. Michael Hermes, I think you're on the phone, and we have a question for you. Over the past few weeks, clients are starting to inquire about concentrated positions in your portfolios. Certainly in Cincinnati, we're home to a lot of people with concentrated positions, such as Procter & Gamble or Scripps Howard. What advice are you giving them in this period of time?
Yeah, so if you are a investor who does have a concentrated position, which we say is a position of more than 10% exposure in your portfolio to an individual stock, such as Procter & Gamble or GE, the downturn actually presents an opportunity to reduce those concentrated positions with minimal tax consequence to you. And so just a couple basic things that I've been telling clients that they could do is to, one, stop the dividend reinvesting inside of that position and use that cash that the positions generate to invest in more broad-based exchange-traded funds and mutual funds to help diversify away some of that individual stock risk. And then the second way is hopefully you work with your advisor to harvest some losses during the last downturn. And so being able to utilize those losses to offset any capital gains that sale of a position may generate would be extremely beneficial as well. So using those losses to offset those gains. But those are really just two of the simple ways that you can help mitigate those concentrated positions in your portfolio.
That's a great answer, Michael. I appreciate that, and I hope that's helpful to our public. Michael Napier, we have a question. You had a question too, if I remember correctly, regarding withdrawal rates. Can you give us some ideas or areas of concern for your clients on withdrawal rates?
Sure, Terry. With the market being so volatile right now, a lot of retiree clients are continuing to take monthly distributions from their portfolio. So taking money out of their IRAs or their brokerage accounts to live on for their day-to-day expenses. Just stressing to my clients and all of our clients here at Horan to keep an eye on those distributions, and a simple way of doing that, a rule of thumb is not to take more than, call it 4% or so of your portfolio per year. So you're taking your distribution, you're dividing that by your account balance or your account portfolio size. If it's 4% or so, that's typically a so-so conservative distribution. If it's a lot higher than that, I think a conversation with your advisor is necessary.
Thank you. Thank you. David, we've got some gray hair between the two of us, and there was an old saw in the investment industry. I wanted to ask you if it still exists. Sell in May and go away. What do you think?
The short answer is that has had the outcome of doing that has benefited investors. Now, that May to October period has actually been an up period for the market, even though it has underperformed the other one. So the real question is, if you do, and it hasn't worked in I think last year the sell in May did not work. And the question is, if you do sell in May, what's going to be your trigger to get back in? Are you actually going to get back in October? We sometimes call it the Halloween indicator in October. So it's tough to do. Market timing's tough, actually. We would say, have a long-term investment strategy and stick with it.
I would agree. And in one of our farmer seminars, we also said in the fourth year of an election cycle, this is a good year for the market.
Exactly.
So no selling in May this year.
Exactly.
Right.
Exactly.
Very good. Paul, can you talk to us a little bit about how the Horan Wealth team continues business as usual in new ways, and give us an example?
Absolutely. Happy to, Terry. So in this age of technology, we've actually put it to very good use. Earlier this week, we had a wonderful meeting. We brought 5 Horan associates into one conference room, all socially distanced. We participated with a vendor as well as a service provider who were remote at unique locations for themselves. And then 5 members, in this case, of a retirement plan committee for a very well-known and respected entity in Cincinnati. Each of the 5 had their own unique, or in their own unique space, and had logged in through the technology. We had a very robust, what turned out to be 2-hour meeting where we got quite a bit accomplished.
That's great to hear, Paul. Glad to know that we're still doing business in this period of time.
We are very much open for business.
Well, and that speaks to the stocks that we think are going to do well going forward, are these technology companies, these internet infrastructure stocks, be it WebEx or Zoom or Microsoft Teams. I mean, we do think that's going to be a theme going forward.
Yeah. I don't want to put you on the spot there, Matt, but data security is certainly at paramount at Horan, and data security is something we continue to make big investments in. Would you say that is the case?
Very much so, yes.
Yeah, we will continue to make those investments because our primary goal is to keep our associates secure and our data secure. Well, thank you, Matt. Thanks for that impromptu comment. We appreciate that. He's one of our IT people, and thank you for putting us on. Thanks, David and Michael, and Paul, and Chris Huggard, who I know is also on the line. As we look towards the future, we are excited to announce to you that we've hired a new financial planner. His name is Nick Groman, and he brings over 6 years of experience in providing comprehensive financial planning to individuals and families. He is currently in his 3rd year of law school with a concentration in estate planning and tax, and he will join Horan Associates June 1. We've enjoyed spending these last 10 Fridays with you. Please continue to look at our COVID landing page on our website, as it is a resource and we continue to refresh it. There's a new posting that's going up now, or is now up or will be, on ways to purchase life insurance in a very expeditious manner. So if you know people, or if you know yourself need additional life insurance, there are easier ways to get it than what there ever has been in the past. Horan will start to transition back to our offices on a voluntary basis starting June 1. Accessibility continues to be our top priority, and we will continue to be diligent and proactive in our communications with you. Thank you, and have a great Memorial Day. And remember, freedom is not free. It was purchased at a cost. Think of that.